LPs, they don't have the same time pressure as you do. Venture capital is just a very small piece of their problem. 80% of global GDP is created in cities. It is also where 70% of carbon emissions and a lot of the negative externalities of that prosperity are created. Sustainability for me is only real if it drives economic advantage, while also having the positive externality. If it doesn't, it's kind of like it's vibe climate. AI have achieved some kind of like takeoff moment, which begins in software and then now is entering also the physical world.
All right, listeners, today is a very exciting episode. We have Jacob Brough, founding partner at 2150, is coming on the show as the fund announces the final close of its second fund at 210 million euros and doubling down on their conviction that cities are the decisive battleground for climate and industrial transformation. You've just announced a 210 million urban climate tech fund. How did the fundraising go?
Well, it was a lot longer and slower than the first one, I can tell you. It was a slog, but you know what? I think it went as it actually really was supposed to, right? It took a couple of years, which I think it's supposed to when you're an emerging manager, and you're doing something which is also emerging as a space. The first fund we raised, it took like a year. More or less. It was extremely fast. And we had a first closing and a second closing like within sort of like half a year distance. It was very unusual times. Now we live in maybe even more unusual times, but in a different way. And I think the fundraising environment changed a lot with interest rates, with global uncertainties, decouplings, war in Europe, all these things that just drove a lot of uncertainty into the picture. And then, we went back to this kind of speed, which I think is normal for raising a fund, which is a couple of years and a lot of kissing a lot of frogs and like the slow, hard road that this business is basically before you maybe get to where some of the big institutions have gotten to over decades.
What were some of the pushback that you've heard from LPs?
Well, I mean, LPs they don't have the same time pressure as you do, right? They have all these options. And then there are all these things that happen in the world where venture capital is just a very small piece of their problem, right? When the whole world is rotating and all of a sudden you have, fixed interest rates coming with low risk, and you have, global politics that create all kinds of uncertainty, and you have an AI, kind of like Sputnik moment happening at the same time that sucks like most capital out of the space. Investors are, they're just like hesitant and waiting. And I think the other thing that also happened is that, people got very exuberant about funds like ours back in 21. We sort of like, we came out and with this sustainability technology thesis that we still pursue. And all of a sudden, like we were labeled the climate tech fund, and like all of a sudden there were like hundreds of the climate tech funds. And when we were doing the sort of like closing of this fund, there was still like a crazy amount of new emerging managers raising maybe even the first fund still out there in the market. And I think a lot of LPs, they realize that, hey, climate or sustainability, is it really that big that you can have all these new investors competing for the quality deals? And I think even you start to wonder, is this really like a vertical, or is it just like an aspect of the economy that has become important and that will sort of like become part of the fabric of investing going forward? It's not that there aren't that, enormous multitude of like fintech investors or very specialized crypto investors, but those domains have become ingrained into sort of like broader strategies of funds investing into technology. So I think that's kind of also the change we're seeing. It's kind of a maturation process where I think that climate has gone from like, oh, this is this new vertical, to this is like this new aspect of the economy and technology change that presents opportunities for investors in technology overall. And that, I think, that leads to sort of like a normalization process.
What did you sell to LPs during that second fund? Because, you know, as you said, you were labeled climate tech before. What was the pitch for fund two?
The pitch was we're going to do more of the same. We're going to do it better. I mean, and we learned a lot of things. So it wasn't really changed, right? Our thesis is quite simple, that if you look at the world, you know, 80% of global GDP is created in cities. It is also where 70% of carbon emissions and a lot of the negative externalities of that prosperity are created and sort of like dumped on the planet or dumped on the poor, or sort of like is not accounted for, if you will, and not necessarily solved. Now, over the next decades, like billions of more people are pursuing that prosperity that is typically found in cities and will continue to be found in cities. And they will go there, they will get there, like kind of like in one way or the other. And if we don't provide this prosperity, for instance, for the continent of Africa, like you can imagine the migration problems that you're going to see, right? So prosperity is an urban thing. Prosperity is a goal for humans, and I think something where we want as many people as possible to benefit. And if you look at, you know, what is the other thing that correlates with prosperity and economic growth? That's energy. It's perfectly correlated, right? So in order to deliver that, and that's why you have the combination of GDP and emissions in a city, right? It's because the economy and economic prosperity, societal prosperity, is a function of energy, like most things in the world. And so we need to bring, you know, those next billions into those cities in a way that doesn't explode the negative externalities. And I think it's a huge opportunity because, you know, the value involved in that is just tremendous. And it's very clear that to get there without breaking the system, you need technology, you need innovation. And the beautiful thing is that the sort of like the essential ingredient, the energy, is being innovated very, very fast. And that we have some of the first categories of disruptive energy technology that is, you know, far superior in terms of competition, being better, faster, cheaper than the conventional stuff. If you compare solar with almost any other category of energy, right? So, and it also means, of course, that the whole energy system has to be reconfigured, and that takes technology solutions as well, and that's an investment opportunity. So, you know, sometimes people ask, like, why are we doing this, or why are you doing this, Jacob? And you know, and people have talked a lot about carbon. They've talked a lot about this little molecule that no one can see, no one can smell, no one can touch, and it's very arbitrary. And I always say, well, this carbon thing is just like a proxy. What it really is about, it's about the future prosperity for the majority of people on this planet that we want to achieve without breaking the whole thing and creating like disaster in one way or the other. And part of that solution is going to be led by technology and innovation. And that's a phenomenal investment opportunity. It's very exciting to work on, we think.
You mentioned kind of the better, faster, cheaper. I'm curious, for the first fund, did you ever believe that climate was enough, or like sustainability was enough as a value prop?
It's a very good question, because it points to what also happened in the last 5 years, is that, you know, there was a lot of optimism. The world was very bright. The world felt like stable and predictable. There were no interest rates, and I think, you know, there was this vibe around everything that has to do with climate that felt like the next new thing. We came out of the pandemic. We had forgotten about like the Cleantech 1.0 failures, but we realized that global systemic risks could really throw everything off, like that COVID-19 did. And looking around, so like, what's the next big thing that might like change everything? And you know, climate was there, ready to grab, and a lot of things had happened for a long time on the regulatory front, in global governance, like corporate behavior, and so on. And so all of a sudden, you had this unlock where, like, the smartest people, all the capital, all the businesses, all the politicians, everyone was just like, yes, we're going to do this, right? And I think a lot of people just like went very fast and forgot to think about, well, how is it going to work and what's it going to cost and who's going to pay for it? And sort of when then the tide goes back and the money disappears and or goes back to some kind of like low baseline, and there's all these other alternatives and all these other problems that you have to solve, like war on the continent in Europe and huge energy crisis and like global geopolitics disruption, then all of a sudden, the mood changes, and then you basically realize slowly that all these like lofty speeches and everything everyone did to feel great and to market themselves and to attract talent and get good publicity and like and hopefully also look good towards their kids and all these things that are human nature and it kind of like became less important, and people started to sort of like thinking about like what are the economics of this thing. And so I think there's a new realism that entered the picture, and I think it's very healthy because it really drives focus on things that work short term or sort of like near term, or you can see their path. And I think it adjusts risks more appropriately, and therefore also costs as an investor. Yeah. So I think overall it's very healthy, and because nobody is really going to pay for this, at massive scale, if it's not going to be faster, better, cheaper. I mean, it's just how the way. So sustainability for me is only real if it drives economic advantage, while also having the positive externality. If it doesn't, it's kind of like it's vibe climate, right? It's not real.
Looking back on the first fund, do you think that you've made that mistake a couple of times, that believing that the value prop from a sustainability point of view was too strong and therefore you have invested, but actually the unit economics were not as good as you expected them to be?
Well, I think like any investment fund that takes risk at the level of venture is going to have to answer yes. Right? So, and not specific to the domain or the sector or whatever. And so, because I mean, you swing for the fences and you just suspend your disbelief that something's going to work, right? And you try to find the first principles, like down to the physics and to the economics and the energy equation. I mean, so you try to work it out, and you get better over time. We got better over time. We were 4 generalists starting this, right? We hired a team of people from science and academia and people who knew stuff we didn't, and we've built domain knowledge. And we have certainly been optimists all along the way, and you have to be optimistic as a venture investor, also as an entrepreneur. Otherwise, you shouldn't be doing it, because there are always so many reasons not to do something, or it's so easy to find the reasons why something will fail. Like, easiest sport in the world. Everyone does it in front of the TV, news every night, all across the globe. But the optimism necessary is essential. You have to suspend your disbelief, and you have to try to find the first principles that are at work here. And we've gotten better at that for sure. I think that one of the things we really tried is to not take like unnecessary risk related to regulation, for instance. Okay, if there is a business model that is entirely dependent on a regulatory environment that might change, because policies and the political pendulum swings back and forth, and it's swinging very wildly now, and will probably do so for a long time between the extremes of right and left, due to the world we live in. That's going to be difficult, right? Because it's completely out of your control, and if it swings the wrong way, then there's no business. And so we've tried to avoid those. We have had cases where a new government comes in, rips everything apart. I'm not going to name names. All of a sudden, like tens of millions disappear from the business plan of a company, and you sort of have to find a way around that. And fortunately, there in that case, right, you have a phenomenal business that this was just an accelerant. It wasn't a existential ingredient, and that's the difference, right? You can have regulatory environments and grant support and all this stuff be accelerants in a system of innovation and change in a society. But if it becomes like existential ingredients, then it's very hard, especially if you're not investing at a very, very early stage where you're spreading bets. But if you do sort of like Series A, maybe an early B, maybe a very mature seed type of investment that we typically do. So, you know, I think we've gotten, we remain very optimistic, but gotten, you know, smarter and more knowledgeable. And I think we've become even more cautious about, you know, what is the regulatory risk exposure? Like what's the next election gonna do to this business model? Or there are these new risks we have to think about, like what happens now after we have had this decoupling of different regions geopolitically in the world. I was in China this summer, and you know, it's just like extraordinary what you see there, and you feel like, oh, we should be investing here left, right, and center. And you realize, okay, that might be difficult for various reasons. And you also realize that, oh, maybe these companies won't even be allowed to sell their product in the US or in Europe. So maybe you can actually fund companies in those regions that may already be technologically behind the Chinese, but you know, maybe those Chinese won't be able to compete. So you have to think about the world a little bit differently now.
Yeah, and you talked about getting smarter in terms of like how you invest. Are there any particular sector or business model on which like your conviction has changed throughout the last 5 years, where you think, okay, that's never going to happen anymore, that's not possible, this is a bad idea kind of thing?
I think the economics of carbon itself are really tough. And you know, the logical thing to solve, to kind of like align everyone in the world, it would be to introduce a global carbon tax. We know it's never going to happen. If we can't even tax, you know, capital in a meaningful, you know, harmonized way across the world, how are we going to solve it with carbon? And I think the markets and the pure sort of like carbon dependent or related business models are very difficult to see come through. So that's one thing. But you know, I think like all these categories that we've been investing into, also the ones where some of the companies may not have you know, done so well because of the macro and because maybe the timing was wrong, right? I mean, I think we still have conviction about every single one of them at this point. You know, it's just a question of timing often. And then at the end of the day, every single company at every single stage, I think, you know, success is mostly a function of team, right? So at the early stage, I mean, we always say at the early stage it's all about team, but in the end, I mean, I think it's about team all the way. and
is that one of your learning from the first fund, that basically even when you invest in like Series A to Series B company, it is still about the team?
Yeah, I mean, I come from an education of like just like excessive, not excessive, like radical focus on team when it comes to building companies and investing in companies. I think coming into deep tech as a generalist and learning about all these new technologies, like maybe you get a little bit sort of like, oh, you spend so much time just trying to figure out the technology that, and I think we had to learn, you know, what does good look like in a deep tech science-based university spin-out company. Like when I go to Boston, I look at a spin-out from MIT. Like, what am I really looking for, as opposed to when I go to Germany and I look for this execution prowess that I've seen before in European venture. That is, for instance, like a 1K5. Like there, I can see, like I know what good looks like. I don't have to learn that. I have to learn what good looks like in the university deep tech spin-out domain, and that takes a bit of humility and a little bit of trial and error for sure. But ultimately, like in every single case, it's about the people, and I think that's the ultimate North Star in venture that you just get reminded of time and time again.
Hey, I've mentioned in that introduction before this episode that I've just started a new role as an investor. I must ask you this question: what does good look like?
Yeah, you know, people ask that often, right? And your team asks you like, what do you mean this is a strong founder, Jacob? And you know, I really try to figure out like how can I make this turn that into a formula? If it was completely formulaic, I think, you know, more of us wouldn't have a job. But I think you often know, it's a little bit like hiring people. If you've hired a lot of people, you know, you typically know in the first like 5 to 10 minutes whether this is it or not. Like your instinct tells you this is, especially when it's not, right? And but you encounter people that are exceptional, and you feel that they're exceptional, and you can tell by a lot of different things, and also it's also intuitive. Like, you have a lot of bandwidth as a human, which is not your language and not exactly what you see, but you receive a lot of, and you read a lot of subliminal signs, and you're not even aware of it, but you notice people that are exceptional. And great founders they're outliers. They're not normal people. That's my experience. And you sense that. And in a way, you're trying to try to falsify that from after those first 5 minutes, when you're just like, okay, this is an exceptional person. Let's figure out if like why we might be wrong, why this person might be just like a lunatic, or why this person might just be very good at presenting and doesn't have the substance. But the best people, entrepreneurship is ultimately about, combining ideas, people, and capital to solve a problem. That's what it's all about, and that's what is done over and over again. And the best entrepreneurs, they're exceptional at identifying problems that others don't see or others don't see yet, and think of solutions clearly, right? But more importantly, they're exceptional at bringing other great people along and attracting them and attracting the capital, so that you can actually build the solution, and you can have a business, and you can create jobs, and you sense that. And there are lots of ways to figure it out. And then they're typically also a little bit stubborn. They have psychological characteristics that are a little bit extreme, and I like to use some psychological frameworks that I know of and that I've used in the past. And you can you can plot people on at least like mentally, right? As a rule of thumb, you like people who have certain characteristics that you think are correlated with being resilient, having super high agency, being not very agreeable necessarily, right? Because you need to stick to your vision and your beliefs, because everyone's going to tell you why it's not going to work, or they should try this or try that. And like, if you listen to all these voices, like, you will go in circles. And anyway, but that's almost like an entire podcast on its own. But I think when you meet exceptional people, and then it's about figuring out what might be wrong here, but you can sort of tell. You can see who joins them. You can see that they can make you listen and make you want to actually follow them. And then they typically have a very unique, deep insight and knowledge about the stuff they're trying to do.
And talking about the first fund and how you've identified people and teams, you caught at least one unicorn that I'm aware of, which is 1,5, really great success in Germany. Let's take the example of that company. You first meet them. What's your reaction to it, and how do you think about the problem they're solving and the team, and what excites you about the company? I guess, right?
Yeah. No, it's an exceptional company, an exceptional team, and Philip, the CEO, is a force of nature, and you feel it immediately, right? And so this kind of like first encounter experience where you say, okay, here is something, like, pay attention. That's very obvious when you meet this guy the first time. And we had spent a lot of time like hypothesizing about what's going to happen with home electrification and the home energy stack, if you will. What are the challenges? What are the problems? How do you distribute? How do you generate? How do you make money? And we had looked at a lot of the other contenders out there trying to solve this problem. And we really, besides like the team being exceptional and extraordinary and unique, and having a very deep history in the space from Tesla and batteries, and they really knew their stuff. They've been sort of like going to China for a decade, working with supply chains, and like just really deep into their domain. We really liked the way they were approaching and understanding the market, and we thought that was the right, resilient type of business model that would work in a very difficult go-to-market, actually. And so far, it's turned out to be true, and we think the opportunity is massive. It's not easy. It takes a lot of resources, but if you solve that and you scale all the way, this is a huge generational company.
And would you say that product is a reflection of the team? Because talking about Philip and the team up there, you said they had the best solution, and he was also kind of an exceptional founder. Do you think that's a very strong correlation often, or do you sometimes see exceptional founders going after the wrong idea?
Yeah, but I think very often exceptional founders go after what turns out to be the wrong idea, but the right general direction maybe. And and I think that's another trait, which is you have this obsession about a long-term vision, but you have the flexibility about how to get there, and that's why you sort of like you find a way, and maybe it wasn't exactly what you thought it was when you started, and that's why the team is so important. If the idea was the thing that was stable, that was constant, right, the team would be less important. But the idea and the solution is not constant. You're looking for it. You're looking for product market fit, and you're looking for scalability, and that search. That exploration, the person who searches and explores the fastest with the best scientific approach, with the deepest knowledge and the most intelligence and curiosity and obsession and just like and does it like all the time, is more likely to be successful than the person who goes a little bit slower. And that's why the team is so fundamental to the success, and the idea is secondary.
Look, I'd be curious to go on the opposite side. So 1,5 obviously is one of your portfolio company and is a massive success. Are there any companies in your entire portfolio that you've missed on? And why would you say you've missed on them?
There are certainly companies that we passed up because we thought, hey, this is too expensive. And we have increasingly sort of like come to the conviction that if something really looks like it's working well, it doesn't matter if it's expensive. If it can become a very big company, you should just try to own some part of it, right? Whereas if it's very early and it's an exceptional team and like a big promise, but it's not really like you haven't proof yet, then obviously you need to be cautious about. You need to be sort of like principled on price and on ownership, because there's that higher level of risk, and you may have to sort of like search and explore for so long that it will cost more money and it will dilute you more, so that at the end of the day, you need to make sure you have enough ownership if it ultimately works. But we have increasingly sort of like said, well, if we didn't get there the first time and things are just really taking off, like we just want to be in the best companies. That's the attitude we have formed as investors, and I think that serves us well.
Well, talking about the second fund, so you've already started to deploy some of the capital. I'm curious, how is your definition of urban climate tech or urban tech, or I don't really know how you call it these days anyway, but how has it changed, would you say, versus Fund 1?
It's been evolving all the time, also in Fund 1, because and it's quite logical. If you assume that 80% of global GDP is urban, like then obviously you can find a lot of opportunity inside that space. And it's more a question of delimiting yourself to not be trying to do everything. And we have so far been quite focused on like, let's identify areas where we think there's high potential, where there's potential unblocking of that prosperity curve we talked about, where technology could have a big impact. And I think we now probably have a view that there aren't that many constraints. I mean, we're not an agriculture fund, right? We're not a space tech fund. We don't do pure fintech. Then it needs to be like very related to energy, which is something we understand. But energy is everywhere in the urban economy. The stuff we build, consume, work with is industrial, right? So a very big part of the industrial supply chain that sort of like allows us to build this prosperous platform called a city is kind of within scope, and we've ventured more into that as we've come along. And what is really interesting now, of course, is that between Fund 1 and now, there's been a pretty important change in technology, which is that AI have achieved some kind of like takeoff moment, and there's a hyper acceleration, which begins in software and then now is entering also the physical world, and all that physical world of manufacturing, energy systems, mobility, etc. is going to have an acceleration because of the way that AI has become liquid and can now enter into, you know, the PLCs of factories, factory machines, into the kilns of cement producers, and everywhere basically. And this is what you see in China, right? When you go there, you realize how intelligent the real economy, the physical economy, is already becoming there. And so, and what is also then sort of like creating this flywheel is that acceleration of machine intelligence in the soft and physical worlds is driving, I think, a once in a lifetime, maybe once in a century type of acceleration of prosperity growth, which is a great boon and high potential for every person on the planet, hopefully. But it also drives a unprecedented acceleration of energy demand because of the compute that's involved in making all this happen. And so, you know, that becomes all of a sudden like this reinforcement of everything we're talking about here. So, you know, it's almost like this intelligence, machine intelligence meets physics meets energy acceleration that we're seeing. It almost feels like the equivalent of, you know, the industrialization of fertilizer that unlocked population growth 100 years ago, that we are seeing this now in the knowledge economy and the industrial economy. Or we are sort of like the cusp of seeing that. And I think the potential there for society, for humanity, and for investors like us is just really exciting.
How does that translate to some of the investment you've made already out of Fund 2? Like, what are some of the, more specifically, if you go into technology or products that the companies are producing?
I mean, we are seeing lots of companies that are now flocking into trying to solve some of these problems. Some have been at it for a while, and some are just entering. But we've made investments, for instance, in robotics, and I've sort of like still unannounced, but we have made investments into robotics for the let's say the world of computing, because there's a lot of capex build out. There's a lot of capex upgrade. There's a lot of circularity actually involved, and robotics can do a great job there. And it's not just robots, like, you know, it's a robot arm, but it's really like you need machine intelligence, computer vision, lots of things to combine, which is now possible, which wasn't possible 5 years ago. And we have, I've alluded to it before, right? We have invested in the company that applies AI at the edge of industrial production sites to optimize like combustion processes or other things that are actually becoming unstable because of low emission fuels coming into the mix that don't combust in the same predictable way as the conventional fossil-based fuels did, which creates yield compression in the output, and that's a huge problem that you can solve, and it's very complex to solve it. But, you know, AI applied in that physical setting can actually do it. So those are some of the early examples we have. We're looking at lots of more like platform software layer companies that are in the market now trying to digitize the entire manufacturing stack. I know you've also done an episode on this topic, right? And there's I think the downstream opportunities from this new technology wave is just, you know, I think we can only start to sort of like imagine what might happen, and where this is all going to go, and that's usually like one of the most exciting times to be investing.
If I may challenge you a little bit, is that urban tech?
We think it is, and
what's your definition of it?
That's exactly what I said, right? The urban economy is, you know, 80% of all the GDP of the world. So it's most of the prosperity, most of the economy is urban. And so for us, urban tech is the technologies that can go in and accelerate. And for us, sustainability is like kind of like a necessity to accelerate this in a meaningful way. Those urban platforms for more and more people, for the next 2 billion or whatever that's coming into cities, to to advance and continue that urban platform. I mean, that all the technology that is needed is potentially in scope, and all the stuff that we are consuming and using and leveraging in the urban economy, has an industrial supply chain most of the time, right? And we've sort of like been, you start by looking at sort of like the end product, like what's happening here in a city. Oh, you have a house, like what's it made of? Or you go back, oh, it's made of some building materials. Okay, what are they coming from? There's an energy system behind it, and so on. So you can travel up the supply chains, and then you sort of like figure out like where's the biggest technology lever for making the end output scale sustainably for like the next billions in cities. And we want to find the biggest lever for technology in that supply chain and put our money there. Like that's kind of like the philosophy, and that's why it's this like thesis with all these these branches into industrial supply chains that are relevant.
Sounds good. Well, thank you so much for today, Jacob. I appreciate it. For listeners, if you enjoyed this episode, don't forget to subscribe to New Wave on podcast platforms like Apple Podcasts, Spotify, on YouTube, or also to the newsletter that comes out every Wednesday to provide an update on European climate tech. Thank you so much, Jacob.
Thank you, Hugo. Appreciate it.